Thanks for joining us today on Market Call. I'm Morella Fernandez. Teal Linde with us on the show, manager of the Linde Equity Fund. He'll take your questions on North American large and mid-cap stocks today. Here's how to reach us. 1-855-326-6266. You can also send an email, marketcall@bnnbloomberg.ca. Teal, good to see you.
Thanks for having me.
You say there are different factors driving share price right now in the market. Can you explain that?
Yeah, sure. Well, traditionally, markets have anchored themselves to earnings, cash flows, economic data, and those factors still matter. But increasingly, it's more about positioning, narrative, momentum that's driving share prices. And, part of the reason for this change is just how the structure of the market's evolved. So now there's a lot more algorithmic trading going on. You've got far greater participation of retail investors. So combined, they kind of create this feedback loop, which sort of reinforces the trends we're seeing. And so as a result, you have markets now that are becoming more detached from fundamentals for longer periods of time. And you can still make money in that kind of environment, but it's a riskier environment. So you've got to pick your spots properly and try to minimize your exposure to the companies that are, or sectors that are at risk of having a snapback when you have reversion to the mean. And for those who think that discount that risk, well, you got 300 years of financial history that suggests otherwise.
Okay. So it's more about the storyline is what you're saying. Can you think of an example off the top of your head?
I think when we go to, there's a past pick, for example, there'll be an example. But I guess the storylines is that the algorithmic trading, retail investors, they don't tend to look at the return on invested capital figures. They're looking at headlines, stories, and it's more thematic themes. And that's okay. I mean, if you participated in anything that's related to AI data centers, you've done well. And that's despite the fact that the fundamentals are starting to look quite out of line. But the problem is that whenever you have these environments where it's based on themes or stories, that's how bubbles are created, and you can really hurt yourself if you don't get out in time.
So would you say that is the case specifically with tech? Do fundamentals still matter in other sectors?
I'll give you an example, like for TFI International, for example. And that's a stock we've talked about on the show, and there's been a freight recession. And now there's signs that the recession is over, and that stock is just catapulted right back up to where it was before, just on these early indications that the freight recession is over. And so the fundamentals haven't recovered, they haven't returned, but just the excitement around that things are getting better. Everyone runs in, the algos have a reason to buy, retail investors, momentum starts to kick in. And what we've seen in recent years that is momentum is really becoming a driver. I mean, once a stock starts moving in a certain direction, the algos, if the black box, if you took them all apart, they're really kind of momentum investing mechanisms. And that's just one example.
Got it. Okay, let's take a quick break. We will get to questions for Teal Linde of Linde Equity Fund, taking your questions on North American large and mid caps today. Here's a number to reach us. We're back in just a moment. Stay tuned. Again, here's how to reach us, 1-855-326-6266. If you have a question today for Teal Linde, who joins us as our guest. Teal, we're going to start with an email here from Gordon. He says, my question is, should I buy the new SpaceX IPO, which is expected around June 12th? I'm sure we're going to get a lot of interest in this. I don't know if your own clients are asking about this, but where do you land on SpaceX?
Well, for the question, I think that this is going to be the biggest IPO of the year. I saw on BNN Bloomberg.ca on your website, there was a headline that suggests that it could be the most popular IPO in 40 years. And so when you have that kind of environment, it's you're probably going to see a pop on the stock. And so if you can buy the shares at the priced IPO, at the IPO price, then that's probably a deal. But it's likely going to pop, who knows, 25%, 50, 100%, you don't know. So to answer the question, should you buy it, you really got to wait to see what the activity is on that day. Now, longer term, this is a company that's expected to have a market cap of around, at the IPO price, of about $1.75 trillion. And last year they had revenues of about, I think 16, 17 billion, 20, maybe 25, 26 billion this year. So it's going to be trading around 80 times annual revenues, and which is very, very rich. Now, the reason why that's being considered as possibly reasonable is that the valuation of the addressable market. I mean, SpaceX is known for its rockets, but it's actually their Starlink, which generates most of the revenues and all the profits. But the big upside is putting data centers in space, because right now on land, the data centers require a lot of power, consume a lot of water. And in space, you have unlimited solar energy. You don't need water to cool down your servers. And the operating expenses would probably be half. And so Elon Musk thinks that they get data centers up there in 30 to 36 months. But then I guess the bearish argument is that Jeff Bezos, who also has Blue Origin, same kind of aspirations, he thinks it's going to take 10 to 20 years before you get data centers into space, because it's going to take that long to get the delivery cost down. So anyways, at 80 times revenues, we think we'd rather just sit on the sidelines, and there's other places we'd rather invest.
Yeah, I'm waiting for somebody to try and capitalize on the energy of the sun out in space, because I'm sure that'll be next. Let's go to the first phone call. Reg is on the line in Winnipeg. Reg, go ahead.
Oh, hi. Thanks for taking my call. Teal, so my question today for you, you're a smart guy, is on Manulife Financial. Now, I've followed this stock for a long time, and my theory on this is, at the end of the day, I don't think it really matters how much profit Manulife makes. And I base that on the fact that when you do a deep dive on this, you look at who owns Manulife stock, 54% of this float of stock is owned by the financials. And if you look at the last minute of every day of trading on the TSX, on Manulife stock, you'll find some very interesting activity, which is those financials that own it trading those shares back and forth to each other. So I think there's just basically a secondary trading platform that allows these shares to be accessed by day traders, hedge funds, short sellers. And it really is unfortunate for the retail investor.
What's your question? Sorry, Gordon. What's your, Greg, what's your question? Yes, go ahead.
It's trading at $53 a share. It should be way higher than that. Just simple fundamentals. Look at the profit on the last earnings release. It's flatline. It makes 0 sense. Thank you.
Okay, thank you for the question. So I guess the question is, it's trading where it should be based on the fundamentals, or is this a situation, as we discussed before, where it's more about the storyline than it tends to be about the fundamentals?
Well, Manulife, for a long period of time, it sort of went nowhere. If you look at a 10-year chart, and it's really taken off in the last, I guess, 2-3 years, and they're freeing up capital from their legacy businesses. They're doing well. I mean, they're enjoying very healthy growth in Asia, where they have more exposure than, let's say, Sun Life, and their wealth management business is doing well. And I think, arguably, it's interesting, I think Sun Life probably trades at a slight premium. I actually think that Manulife should be the one that should be trading at the premium. And so, but I think that because of how much the stock has come up, there's probably some resistance just because of that. And but relative to the banks, Manulife does look attractive. We've always owned the banks over the insurance companies, but today I think we'd be more comfortable buying a stock like Manulife rather than buying a bank stock.
That was for Reg. Let's go to Chris in Delta, BC. Chris, go ahead.
Oh, good morning, Morella. Teal, I'd love your opinion on Lululemon. It's covered on the show every once in a while, and some people sort of pound the table as a buy, but the stock is sort of dying a slow death, and every time I add, it goes lower. And I'm wondering if you see it as a buying opportunity, or is it sort of time to put a plug in it and see where it goes? And I guess a final question would be, is there a chance that this company would be bought by private equity or go private somehow? I'll hang up and listen. Thank you so much.
Thank you for the question. There are a number of things, as you know, I'm sure, Teal, weighing on Lululemon, one being competition, one being the changes they're going through with CEO, et cetera. But would you sell it at this point?
Well, we don't own Lululemon, so we don't have that. We don't ask. That's a question we don't ask ourselves. But I guess, I mean, you're right about the competition. Well, there's a couple of questions there. Well, I mean, could private equity buy it out? That certainly could happen. I mean, they got Elliott Management, I believe, as a shareholder, and so the valuation is trading down close to 10 times earnings roughly. So it is inexpensive. However, my concern is that they could be suffering what's happening to Nike. And Nike is losing market share to Hoka and On Running. And Lululemon has two competitors that are nipping away at its market share, and that's Vori and Alo. And these two retailers, they purposely set up their stores within walking distance of Lululemon and to intercept Lululemon customers. And so that's the concern. Now, to Lululemon's credit, I think Nike, basically it was a self-inflicted error where they basically took their footwear off the shelves to open up room for their competitors. And that was a big mistake. Lululemon is it basically is the category creator, and eventually you're going to get people to try and move in there and try and take market share. And so, how successful those two competitors are going to become, that's the question to really answer, and it's difficult.
Okay, let's take a quick break. We're going to be back with Teal Linde, Linde Equity Fund. Again, taking your questions on North American large and mid-cap stocks. Back in a moment. Welcome back. Teal is our guest today. Sydney is on the line in London, BC, with a question. Sydney, go ahead.
Hi, thanks for taking my call. I've got a question about TELUS. It's been going down a lot, and it's been staying kind of suppressed. What are your thoughts on it long term, and what are your thoughts on the new CEO, Victor Dodich, being able to turn it around as a long-term hold? Thank you.
Okay, thank you for the question. Teal, thoughts on TELUS and the change of ownership? I think the follow-up question to that is going to be about the dividend.
Yes, I mean, so TELUS is a stock we've owned for quite a while, and we're actually looking for an opportunity to exit it. And I mean, so TELUS, I mean, it's not really TELUS, it's the entire telecom sector. It suffers from, there's just a lack of population growth now in Canada. And then it's got and then fierce competition amongst themselves. A lot of promotions over the last several months, and then they have a regulatory body that's trying to increase even more competition. And so much so that these companies now are cutting back on their capital expenditures because they can't justify making the investments because the returns are getting that much more difficult. And so I just think just from a higher level, it's just a sector that doesn't have much growth in it. And so the dividend is attractive. That's why we have owned it. But there is talk that maybe the dividend's got to get cut. So anyways, it's a great stock to own when the market takes a massive hit because it holds up well. And that's what we kind of been waiting for as an environment when if the market does eventually take that massive hit, we'd probably sell it to take advantage of other stocks elsewhere.
Let's go to the next caller then. Frida's on the line in Chilliwack, BC. Frida, go ahead.
Hi there. I'd like to know your ideas on Shopify, please. Thank you.
Thank you for the question. Shopify has been hit by concerns about software, like many of the stocks in that space, and hasn't really recovered. But what do you think about their business model and whether it will continue to be affected by AI concerns or whether there's some bounce back to be seen?
Well, you're right. It hasn't. The software sector has seen a lot of recovery. And theirs hasn't come back as much for sure, but they're aggressively sort of repositioning themselves to be sort of like the system of record for e-commerce, and they've got this powerful sort of partnership with Google, where they recognize that agents now people are going to use AI agents to do their shopping, and so therefore they're working on technology that will enable their customers' sites to be able to communicate with these AI agents. And of course, they need a standard protocol, and that's where they're working with Google. And so I think that they're making some very smart moves. Now, the valuation of Shopify has always been very expensive, and so that's probably one of the reasons why it's come off. It's just 100 times earnings. And so it's still expensive today. We really like the company, but it's the valuation that's concerning. And as I mentioned earlier in the show, when you've got a market that's detached from fundamentals, and you have a lot of downside when that reversion to the mean happens, and Shopify does have a lot of downside with the valuations that it's trading at if the sentiment was to sour on it like it did back in 2022.
Just wondering if there is a price you would be more interested in for Shopify.
Well, I mean, company grows around 20 to 30%. And so if it got to 40 times earnings, I'd be in.
You'd be in. Okay. Let's move on then to the next caller. Patrick's in Halifax. Patrick, go ahead.
I want to ask Teal about TD Bank. I wondered if he thinks it's a time to take profits. Retired, it's in my non-registered account. I bought it in the mid-70s. And also, why is it down almost $4 today? Thank you.
Okay, thank you for the question. TD had a lot of way to go after getting penalized in the U.S., and so it's done a lot of growing in the past year. Do you see more reason to hang on to TD? Do you think there's more growth here?
Yeah, the bank stocks, we've owned TD for over 20 years. And in those 20 years, I've never seen the valuations of the banks of the group get to as high as they are today. And so, congratulations to the caller when they bought it around in the mid-70s, because I think that was the low end when they had the anti-money laundering troubles. But it's rallied hard. It's really recovered. And now it's trading over 16 times this year's expected earnings. Now, in the 20 years I've owned this stock, I've never seen bank stocks get over 13.5 times earnings. That's always been the ceiling. And so now they're trading over 16 times earnings. That's really rich. And so we've been trimming our bank stocks. We think that we continue to believe that they're solid long-term holds, but considering how much they've increased or they've gone up in share price, the weightings have gotten quite large. So we have been trimming. So the caller asked, should I sell? I wouldn't sell the whole position, but you can certainly be in a position where you can take some profits.
Okay, that was for Patrick. Let's move on to Bob in Toronto. Bob, go ahead.
Yeah, hi, Marilla. Hi, Teal. Thanks for taking my call. Teal, I'm just wondering your thoughts on Microsoft. It's moved quite a bit over the past couple of weeks. So I'm just wondering what the impetus for that was, and do you have a target price on it? Thanks a lot.
Thank you for the question. Microsoft, again, one of those software companies people have been worried about, and their AI, some worry, is going to lose to the competition as far as usage goes. But Microsoft, where are you with it?
Well, I guess the caller said, what was the impetus for this rally recently? And I'd have to say it's their breakup with OpenAI. Remember 2-3 years ago, the two companies basically married each other, an exclusive arrangement that, and Microsoft would support OpenAI and OpenAI would only deal with Microsoft. And that became a problem because eventually OpenAI became perceived as not the leader. Anthropic sort of took that title, and Gemini has been moving up. And so Microsoft had gotten sort of married itself to a company that wasn't doing as well. And so they've recently decided to break up, and they still work together. But now OpenAI is allowed to go and do deals with other hyperscalers, like it's done with Amazon. And now Microsoft can now become more sort of agnostic and allow other AI models, such as Anthropic, to operate, to be a layer on their Azure, so that the Microsoft customers are no longer just sort of forced to deal with OpenAI. They can deal with any AI model that they'd like. And Microsoft is also working on developing their own AI models that are sort of custom and tailored to what Microsoft does. And so I think that's a big reason why you've seen a lift in Microsoft stock.
Let's take a quick break then. We're going to be back with Teal and his past picks when we come back. Stay tuned. Welcome back. Time to go through past picks for Teal Linde from June 23rd of last year, so just under a year ago. Teal, at the time you chose UiPath on the New York Stock Exchange at $12.23. It's down to US $12.12 today, so under 1% drop return and total return. This is a software robotics company. They do the software for robotics. Have you held on to the stock, and do you feel like there's going to be some growth here?
Well, I mean, this is a stock. I mean, we recommended it a year ago, and it's robotic process automation. So they automate tasks that humans would do in front of computers, and so we recommended the stock, and then in October they announced some partnerships that were for AI related, and the stock just zoomed up to over $18, and which is up like 50% in 4 months, and then it fell back almost it retraced a lot of that back in November into early December. And so I thought, well, darn it. And so we just decided, well, the next time that happens, we're out. And then within a few weeks, they announced some results and indicating that these partnerships that they entered into are going to start to show some revenue. But they said that the revenue was not going to be material enough to actually move the top line much this year. And yet the stock went up to $19, and we decided to sell at around $19 the day it hit there. And fortunately, I was on market call with a week later, and I was able to share to your viewers that if you own UiPath, sell it. And so it's now come all the way back full circle, and it's not one that we would consider buying back today.
Good to know. Let's get to the next past pick. Pembina Pipeline, PPL on the TSX. At the time last June, it was 50.59. It's up to 64.31 today, so 27% return, 31% for total return. And I imagine you've held on to this one?
Yes, that's correct. And this is also one of the examples you asked at the beginning of the show. Do you have any examples of a stock that's sort of is benefiting from being in the right position or right narrative? And the pipeline utility stocks, they're seeing their share prices really soar. I mean, these are pretty slow-growing companies, but because there's so much demand for power to fuel these data centers, companies that are in the power industry are seeing their multiples expand because of the excitement in the area. And so that's helped Pembina, of course, but also it's a quality company. It's one that we continue to own because it's got a healthier balance sheet than TC Energy and Enbridge. It's got a more conservative payout ratio, and the growth outlook for the next 5 years is also very healthy in that they've already have all their projects most of their projects are already sanctioned. And they also have the benefit of having underutilized capacity where they can just increase their throughput to grow their business, which is a much lower risk way to grow than having to wait for a final investment decision and building up entirely new projects. So we like it still.
Let's move on to your last past pick. June of last year, Delta Airline, DAL, on the New York Stock Exchange. Let's have a look at where it was, which was $48.25 at the time you recommended it, U.S., to $80.50 today. So we're 67% return, total return at 69%. So this company obviously has done well, travel doing well. Is there something else that this company is succeeding in that has pushed that share price up?
Well, it certainly isn't the fundamentals because at the beginning of this year, the earnings management was adamant that they expected earnings to grow 20% this year, and then once the war in the Middle East happened and oil prices shot up, suddenly their input costs for their fuel costs have moved a lot higher, and so their earnings outlook growth for this year is like -6%, -7%. Now again, it's like we talked about. Typically in the past, the share prices have moved with the earnings, but we're not in that kind of environment today. And so the earnings have gone from +20 to -6, and the stock last week was hitting an all-time high. And so why is that the case? Well, it's because with all these fuel shortages around the world, North America airlines actually have access to fuel. So that's a plus. And then Delta Airlines has got its own refinery. So amongst the North American airline companies, Delta stands out. And so, I mean, we talk about, so they're well positioned. It's a strong narrative. So Delta Airlines stock hits all-time highs last week, even though the fundamentals are actually completely deteriorated a lot on the earnings front for this year.
But having their own refinery obviously would be key right now.
It's helped mitigate the gap. I mean,
absolutely, that gives them a big edge.
But they're still paying higher fuel prices than they were before, and that's why their earnings are down this year, despite the stock hitting all-time highs last week. All right. So we continue on. I mean, we're long-term investors, and I suspect that when fuel prices start to go down, the narrative will be like, well, buy airline stocks, and maybe we'll move even higher.
Okay, one to watch, Delta Airlines. Let's take a quick break. Teal Linde is our guest today. He's taking your questions. We're back in just a moment. Welcome back to Market Call. Jamie has written in a question today for Teal Linde. He says, please comment on Bird Construction. Am I too late to get in? I know Bird's had a run-up after a couple of announcements and infrastructure bills that they will be taking part in. We'll take a look at the line chart, look at that run-up in a moment. Do you think it is too late to get into Bird?
Yeah, I think it's probably going to move higher. It's because they've done very well with the construction contracts and basically LNG terminal expansions, defense infrastructure spending, renewable projects, and they've got, and as you mentioned, they've just recently landed the contract to be the the lead construction company for Bell Canada's data centers that they want to build across Canada, and so lots of good news there. And I suspect that particularly with the Bell Canada, with the data center construction contracts they're going to get, I think the stock has room to move higher.
Okay. And a reminder, Bell is the parent company of the channel under the Bell Media banner. Let's go to Neil in Toronto with a question. Neil, go ahead.
Hi there. My question is, do you think United Health is a good long-term investment?
Okay. Thank you for the question. I haven't looked at United Health in a while, so we'll pull that up in a moment. It suffered greatly last year and was a little bit slow to come back after everything that happened in the U.S. Are you invested at all in the space? Are you invested in United, Teal?
No, we're not. And United Health, I think that it's had a tremendous run, but I think the challenge with United Health is that it relies on federal and state funding through Medicare Advantage for a lot of its revenue. And at the Linde Equity Fund, we kind of avoid companies that rely on the generosity of federal and state and government funding, because the governments are really they're really feeling pinched with their deficits and their debts. And so that's why United Health at the beginning of this year, they expected their revenues to be down for the first time in many, many, many years. It's because the Trump administration is basically is reducing the reimbursements on the Medicare Advantage. And now I think it's improved a bit. I think the revenue forecast growth for this year is 1%. But anyways, the glory days of being able to grow based on generous funding from state and federal governments to help cover your medical insurance costs, I think those are done. And you look at what the Trump administration is prioritizing and what they want to spend money on, it's going to be hard for them to replicate the kind of growth that they had in the past.
Yeah. And we tend to take a look at the 1 year. We just pulled up the 5 year, which is a better idea of United Health, because when you look at the 1 year, you think, oh, it's coming back. But then you realize at the end of 2024, I guess in the fall, it was at $594.40 US down to the $378 range today. So that's where it stands. Let's go to Darren on the line. He's in Ottawa. Darren, go ahead.
Thanks so much, folks, for taking my call. My question's on Equinox Gold and just gold stocks in general. I know that gold's come off a little bit with this conflict in the Middle East. Just wondering what your outlook for Equinox Gold and gold in general over the next 2 years.
Okay, thank you for the question. Teal, go ahead. Thoughts on the miners, specifically gold?
Well, the gold price is pretty hard to predict, and so I probably can't really comment on that or at all, really. But with Equinox, I mean, they've just done this merger with Orla Mining, and so they're going to be the second largest gold producer in Canada after Agnico Eagle, and producing 1.1 million ounces. And they have the two companies that are merging together, they each have a couple of growth projects or development projects that they believe that could get the production up to 1.9 million. In the years ahead. So the upside is there, but it's really going to come down to execution, and that's always been a challenge in the mining industry. So and that's what you're going to have to keep your eye on and have faith in.
Do you see, I know you said the price of gold is hard to tell, but it has taken a backseat in the conflict and sort of acted a little differently, we'll say. Do you think it could just remain going a bit sideways for the next little while?
Well, when you consider how much the price of gold has run up, I mean, I saw a chart that suggested that and if you go back 50 years, gold does have these big surges. But the recent surge last year was the biggest of the surges. And so, I mean, to expect gold to move higher, I think that's probably expecting a lot. I think probably the gold price probably takes a breather, or maybe it pulls back. I mean, it has a history of shooting up and coming down too. But again, it's a very speculative subject to where commodity prices, particularly precious metal prices, go.
Let's go to the next email from Frank then. He says, is Aritzia a buy at this time? Canadian retail company doing really well, expanding in the U.S. I know that. What do you think about Aritzia? Are you in any retail?
Yes, we own Aritzia. It's one of our largest holdings. And sometimes it is our largest holdings until we have to trim it. And so, Aritzia, it could be the quintessential Peter Lynch stock. I mean, Peter Lynch was the manager of the Fidelity Magellan Fund, and he achieved a 29% compound annualized return over 13 years. And he did really well with retail concept stocks. In fact, I read that once that his best performing stock ever was Dunkin' Donuts. He bought it because Dunkin' Donuts started in Boston, and Peter Lynch started his career at Fidelity Investments in Boston, and so Dunkin' Donuts, after expanding across the city of Boston, then expanded across the state of Massachusetts, the Eastern Seaboard, across the United States, and around the world. And so at Aritzia, same kind of sort of start. I mean, it started off in Vancouver, it's spread across Canada, and now it's spreading across the United States. But it hasn't opened up a single store in any other country outside of North America. They're only in half states right now in the United States, so it's still early innings. Actually, I'll give you another stat, is that Zara, which is often comparable to Aritzia, they have 2,000 stores around the world. And Aritzia only has about 140. So in terms of innings, Aritzia, you could argue, is only still at the bottom of the first.
Okay, let's take a quick break then. We'll get to more phone calls for Teal Linde of Linde Equity Fund. Again, taking your questions on North American large and mid caps when we come back. Welcome back to Market Call. Corey's written in a question today for Teal. I was wondering what your thoughts were on Dollarama. Let's pull up the Dollarama chart if we can and take a look at that. Dollarama was doing really well for a while, but I feel like there's a lot of pressure right now on consumers because of inflation. Is there anything holding back the stock for Dollarama?
Well, the valuation got really high, and so when you're trading at a rich valuation, any kind of negative news will hurt you. And so, I mean, Dollarama, I think their same-store sales growth softened up. There's a deceleration of growth in their Latin American operations, and they've recently announced how much it's going to cost to turn or to sort of, I guess, revitalize the reject shop, the Dollarama Australia, the chain they bought there. Mm-hmm. But but getting to the call, I guess the email question on one of my thoughts is that. Actually, Dollarama is a stock that I try not to think too often of and too hard about, because it's one of those stocks that sort of got away on you. If you had, it's like a Peter Lynch. It's a perfect Peter Lynch stock story. If you bought Dollarama in 2009 when it IPO'd, if you put $10,000 into the stock, it'd be worth $5.5 million today. So Dollarama has basically grown at a 27% compound annualized rate of return, which is doubling your money every 3 years. And so, I mean, it's a phenomenal success story, but I think, there's certainly regret that we didn't own it during that period, but it's sort of it's why we all enjoy investing in stocks. There's other opportunities out there, and it's just, you just got to go out and find them. And that's a big motivator for us. And I think that's why many people enjoy investing in the stock market.
Yeah, follow or find the next Dollarama. Okay, let's go to the next email from Kurt. He says, long-suffering holder of AQN, Algonquin Power. Anything good on the horizon for this company? Is there anything good on the horizon for Algonquin?
Yes, there is. Yep. Algonquin is really simplified. They're focusing on regulated utilities. I mean, for a while they were expanding into renewable sort of projects, and that didn't quite work out as planned. And so they're focused on regulated utilities. And the opportunity they have there is that when you're operating a regulated utility, so the government's sort of mandate for sort of mandates or limits how much profit you can make. And so Algonquin's actually been under-earning what it's allowed to make. Now, you have to sort of apply for it. There's a lot of work involved. But now that they're focused on just the regulated utilities, I believe they have a target they want to get to and to increase their profitability. But the target, the internal target they have is still less than what their allowed is their maximum profit. So I think in the years ahead, that's the opportunity to increase their profitability to what their internal target is, and then eventually what to their maximum allowed profitability.
Okay, let's get to one more email then from Brian. He says, may I have your guest analysis on Keyera, so Key on the TSX. Do you own the stock? If not, what are your best recommendations in this space? Keyera, Teal.
Yeah, we don't own Keyera. We do own TC Energy, Enbridge, and Pembina. And I would suggest of the three, if we had to buy one today, it would be Pembina, for reasons we talked about during the past picks.
Okay, and you'd still put new money in?
If I had to pick a midstreamer today, it would be Pembina. Okay. It's just that the valuation is not quite as high as Enbridge and TC Energy. And being a smaller company, they still have more optionality of how to grow. And yet they're bigger than Keyera and a bit more diversified. So if we're buying a midstreamer, you usually buy them because it's a conservative investment. And so scale and diversification counts. And so that's why we own the big three.
Let's get to one more email then before we have to take a break from Mary. She says, may I please have your opinion on Wells Fargo? Also just interested, if you don't mind, on financials in general. We talked a little bit about TD Bank and valuation concerns in this country. What about Wells Fargo?
Well, in the U.S., the valuations aren't as high. Like Canada, I just saw the average P/E ratio of a Canadian bank is now 15.5 times earnings. If you look at the big six, based on what they expect to earn for this fiscal year ending in October, and like I said, over the last 20 years, you never see them get above 13.5, and so the average is now 15.5. The U.S. banks are trading at more reasonable valuations, and Wells Fargo is, I think it's around 11.5 or 11. But I wouldn't buy Wells Fargo because they were under this cap where they had they could only have $2 trillion of assets because they got in trouble several years ago, and so that cap's been released, and so management's now been aggressive trying to catch up. And taking on more credit card loans and auto loans, but they're doing it at the wrong time in the cycle. You're seeing increase in delinquencies in those two categories. So I think it's the wrong time for. Wells Fargo coming out of the gate. I can appreciate they want to try and catch up, but the timing's not good. We prefer to own Bank of America or JP Morgan.
Just in the space in general, North America, because we've seen insolvencies up as well in Canada. Is credit an area of concern for you right now?
It is, and that's why you'd think the bank stocks would be coming off in Canada more because of what you've just pointed out. But the Canadian banks are doing very well right now in their wealth management businesses and their capital markets businesses. And so those businesses, particularly wealth management, has grown so much that it helps to offset weaknesses or concerns on the credit side.
Let's take a quick break then, Teal. We will come back with Teal's new top picks when we return. Stay tuned. Join us tomorrow for Market Call. Joe Hedgener will be on the show, CIO, founder of Asterzoa Capital. He'll take your questions on North American equities. That's tomorrow. And if you missed Market Call, you can check out our daily podcast on iHeartRadio and other platforms. You can also tune into full episodes on our YouTube channel. Let's get to some new top picks from Teal Linde. We're going to start, Teal, with HubSpot. Hubs on the New York Stock Exchange. They're kind of a multi-platform tool for smaller businesses, I guess, but tell me more about them.
Well, I regret that since I submitted this top pick to your producers this morning, it's already up about 17% this morning.
Wow.
So I know.
What's it leaning into?
Sorry, what was that?
What's it gaining on?
Well, I think there's the software sector has been running up lately. I mean, the software stocks took their biggest hit relative to the broad market ever in the first quarter of this year. And the IGV software ETF was down 25% in 2 months. And I believe as of right now, it's down only maybe 1 or 2%, or even with the year. So we've seen a large comeback. And but with HubSpot, I still think there's upside, even though it's up 15% this morning, 17%. And because it's still down 35% year to date, and it's still down almost 65% from where it was a year ago. And so, and the big opportunity here with HubSpot is that they are sort of they're sort of embracing the opportunity of AI and to introduce it to their clients. And so what's interesting is that HubSpot announced results just recently, because I recommended it as a top pick 3 months ago, and then they announced results where they beat and they raised on revenue and earnings, but the stock ended up going down 20%. Because the company said that they're changing how they're pricing their services to include AI. And so the analysts thought, well, we'd like to see some more evidence that pricing is going to work, and the stock sold off. Insiders bought $2.5 million, so obviously a show of confidence. And now we see the whole sector, including HubSpot, rallying up.
I feel like we're going to see a lot more of that, where the AI offerings, if they were free or you could initially try it for a little while, now they're going to start charging you a little bit more for that. And so a lot of companies could benefit from this, not just HubSpot.
Well, you make a very good point. I mean, the reason why the software stocks sold off last quarter is because they thought that AI and AI agents are going to replace all these subscriptions for $200 a month. But if you've got companies now that are going to create digital workers that are going to replace people that you had to pay $5,000 a month for, that software that you're going to be offering is going to be worth a lot more than $200 a month. And that's really the opportunity. You got to find those companies that are going to be offering those types of sort of digital workers that can hopefully supplement and not replace human workers, but just allow companies to buy. And if you can hire a digital worker that's going to have the same productivity as an employee that you pay $5,000 a month for, do you really care that the company's going to lose a $200 a month subscription if they're going to replace it with something that they can earn $2,000 a month? I think that's really the real opportunity is for what's happening now in the software sector.
The trade-off definitely begins. All right, let's go to your next topic. Collier, CIGI on the TSX. This company is in real estate. What do you like about it?
Well, again, this stock sold off 25% in 4 days in February because there was this concern or this fear that AI was going to replace human brokers. And I've talked to a couple of people in work in the commercial real estate industry, and they thought it was laughable. Now, someone who took advantage of that sell-off in those 4 days was the CEO and chairman, Jay Hennick. He bought $16 million US worth of stock after that, when that sell-off happened for his family foundation. Now, and then if you look at the chart, you see in February, the stock continued to slide. And so last month, he bought $29 million US more of the stock in an account that he indirectly holds. And so, getting back to the fundamentals on this, if you can pull up a 5-year chart, perfect. What's happening this year is that the company is expected to earn record earnings per share, right? Its highest earnings per share ever. And yet the stock is trading near its 5-year baseline. So this is an example where the share price is detached from the fundamentals going the other way. I mean, the share price is oversold to the downside when the fundamentals, the earnings, are about to hit record highs this year. So I think that's an attractive setup to be an owner of Colliers today.
Let's get to your last topic then, which is Blue Owl Capital, OWL, in the New York Stock Exchange. We talked a little bit about private credit concerns. This would be a company that was affected by that in a big way. And are you looking at a pickup or turnaround because of sort of concerns that are out of whack?
Absolutely. I mean, you pointed it out. It's private credit concerns. And what led to those concerns is the private credit, the loans that were made to software companies. And so when there was this panic that software companies were all going to get disrupted by AI, suddenly retail investors said, well, I better not own Blue Owl Capital, their private credit funds anymore. And so you had this massive exodus, and they got gated, and you heard about all these redemptions being maxed out. And yet what happened is the software sector is recovering, and it looks like those fears are overblown, and yet Blue Owl stock has not really moved up that much. And so I think there's an opportunity there to capitalize on that. I mean, Blue Owl has also announced results recently, and they were pretty solid. They raised $9 billion more of fundraising, raising their AUM to $315 billion. They remain committed to their dividend, which pays about a 9% yield. And in that fundraising, they got $4 billion more of private credit investment, primarily from institutional investors. The retail investors are off on the sidelines. And Blue Owl Capital, if you look, these large alternative investment management firms have a strong history of coming back from periods of trouble. Okay. And they are the newer player, and they are the smallest, but at $315 billion, they are part of that cohort. So I think it's an opportunity here for at this price.
Got it. Teal Linde, got to leave it there. Sure, I'm out of time with you, but thanks for joining us today.
Thanks for having me.
And thank you for joining us today for Market Call as well. We'll see you back here again tomorrow.